investing. We have here today Joel Teasdale from Dimensional Fund Advisors. He's the head of wealth management in Asia ex Japan. He's been we've been friends with Joel for a while now. We love what Dimensional does, and we'll get into some of that later on in the presentation. Joel, do you want to quickly say hi?
Yeah, good evening, ladies and gentlemen. It's great to be back speaking with the Endowus community.
Great. Really quickly, everyone, if you like our content and you've seen our content, please subscribe below. It helps us in letting our content reach more people, and it will also alert you when we have new content. So please subscribe below with the button. It's a bit on the right-hand side of your screen. So please push that button for us, and we hope to keep on providing useful content to help you reach your wealth goals. Next week, we have a presentation on Endowus FundSmart, a solution that we provided Endowus. We'll go into more detail on it next week. Really excited with the capabilities of that solution for yourself and your portfolio. For those of you who are joining us for the first time, Endowus focuses a lot of its attention on education. We think education is the foundation for making good financial decisions, good wealth decisions, and having a good wealth outcome. Endowus is the first and only digital advisor for your CPF, SRS, and cash. We are a technology-first platform. We're licensed by MAS, and we have thousands of clients across CPF and SRS and cash invested with us today. Really quickly, our mission is simple in our view, but obviously coming up with the right solutions to get there can be challenging. We believe that if we can help people invest better, they can live easier today and live and prepare better for tomorrow and through retirement. If we do this for people, Endowus has done its job in your life, and it has done its job to make the world a better place in our view. As a result of our efforts, again, we are the first and only digital advisor for CPF, SRS, and cash. We also have cash management solutions where you can earn projected returns of 1 to 2%. And now we have FundSmart, where you can customize your portfolios on access to the best funds in the world with very, very fair, transparent, and low fees, something Endowus really cares about and is trying to push the boundaries of in Singapore. We started Endowus out of a personal pain point. We came from large financial institutions and technology institutions. Myself, I started at UBS in the investment bank covering Asia Pacific. I then moved to Grab Taxi when Grab was taxi only and cash only, if you remember those days in 2015, where I started the payment business and led technology partnerships. I then left Grab to really solve a personal pain point of trying to invest well for myself and my family, which is what started Endowus. And we focus on 3 things at Endowus. We focus on access to better products at a lower cost with aligned and suitable advice. We do this by advising, building, executing, maintaining your investment portfolios that are suitable for your goals. Endowus is a financial advisor. You control everything on the Endowus platform. When you create an Endowus account, you get an account in your own name at UOB Kay Hian, Singapore's largest broker. And then we work with you to make sure that your portfolios are well positioned for your future. Again, access, advice, and cost. Something we're going to be talking a lot about today is evidence-based investing. And that is very crucial to what we believe. On access, we don't try to invent products on our own. There's an entire industry doing that. So we partner with the best fund managers in the world, stand on the shoulders of giants to access their strategies and make them available to you in Singapore dollars, in tax efficient structures, such as the UCITS range of funds, with low fees, no sales fees, no transaction fees. And when there is a trailer fee, which is a fee that fund managers typically pay distributors or financial advisors, we rebate that entirely to you so that we are only paid by you and therefore aligned to only serve you. We started to use dimensional product very, very early on in our journey. And just 2 points I want to raise before I pass the presentation over to the folks at Dimensional. We like Dimensional because they do what they say they're going to do. They are diversified and low cost. The trouble a lot of times with financial planning and wealth planning is that you cannot rely on a manager's ability to capture the returns of the asset class that they are set out to capture. And with Dimensional, we do not have that fear. They have been executing systematic portfolios since 1981, implemented by the brightest minds in the industry. And I think being able to access this quality of implementation from Singapore in their Singapore denominated share class is really a treat for investors of all sizes. So with that, I'll hand it over to Joel from Dimensional.
Greg, thank you very much. Just while we're transitioning to the Dimensional slides, I cannot see them yet up on my screen, but momentarily they should be with us for the introduction to Dimensional and equity investing. So, ladies and gentlemen, it is great to be back. We always love the opportunity of connecting directly with end clients and particularly with firms like Endowus, who are passionate about fiduciary-based independent advice. They're passionate about education. They really want to make sure that investors get the returns that are owed to them. And unfortunately, as Greg said, if you're in the business of wealth management or financial planning, often that's really hard to do because there are a lot of conflicts of interests that sometimes sit between people who are in the business of funds distribution and the investor. And it's definitely not the case with Endowus. I remember the first time when we met the team before they had even got off the ground, and they shared their plans, vision for what they wanted to do, which is bring low cost scientific investing to Singaporeans. We were thrilled to have the opportunity to work with them, and we really enjoyed the relationship. So with that foundation, I would love to encourage anyone who's listening today to ask questions around Dimensional's philosophy, how we work with Endowus. And if I had to try and frame that, I would say we are a very important engine or a building block that's used by Endowus for your benefit to try and get the returns of the asset classes you're exposed to in the most scientific and low-cost way. And I use those words because investing really should be boring. For many people, they think it's exciting. A lot of people in the investment industry are actually in the entertainment industry. There's a new story to sell each week, the latest deal for us to take advantage of, or some mispricing that quite fortunately someone's brought to your attention. That's a great deal you need to jump on right now. At Dimension, we have a very different view of capital markets. We think that mispricing's few and far between. They're very hard to identify, and quite often the things that we need to do to build wealth are against our natural instincts. Because as investors, like in most things in life, we think if we're well educated or well informed, we have access to more information, then we might be able to make better decisions. And that's the narrative that's espoused by, it's called the wealth management distribution community around the world. And it's a lot more simple than that. If you've got a good plan, if we remain disciplined, we stay focused on what we can control, then we can have a good investment over the long term. What's the long term? How long is a piece of string? But I would preface this to say that I think many people take the view of equity investing is that you can judge performance over a short period of time. A 1 year period, a 3 year period, a 5 year period, 6 month period, even a 10 year period. That's really noise when it comes to equity investing. It's a long-term game. So we need to understand how capital markets work. We need to be disciplined in order to get the returns that are owed to us. Greg, that's my quick introduction to what we were hoping to speak about today. Anything else you'd like me to share, or places you'd like me to focus my attention before I dive into sort of who is Dimensional and what we believe?
Yeah, just one thing to note for those listening, and thank you again for tuning in. It is an early evening slot. We do these things live for a reason. I mean, we don't pre-record them. We do them live so that they can be interactive, and we want to be able to answer your questions, and hopefully they answer the questions of others at the same time. And we want to do it very transparently. So we encourage you to please ask questions in the chat, in the YouTube chat function, and we will pull some out. And we also have data prepared. And if those questions are asked, we can pull out data that may help to frame some of the answers. So please use the chat function in YouTube to send some things our way. So thank you, everyone.
All right. Thank you, Greg. So we might move on to the next slide. So for those of you who do not know who Dimensional is, I'm not surprised. We're a pretty well kept secret, and generally that's because we don't advertise in mainstream media. We don't pay anyone to sell our products. And I think until very recently, we've pretty much been known to people in the investment community, in the institutional side, in the sovereign wealth space, or to fee-based financial advisory firms. And unfortunately, there hasn't been so many of those in Singapore until the last couple of years. And it's great to see more firms like Endowus wanting to reach out to work with Dimensional. But we've been around for a while. So as Greg said, we were formed in 1981. So we're going on 40 years. Based on what markets are doing, we managed, give or take, $500 billion of assets under management. We're a small firm in terms of employees, just 1,400 employees in 13 offices around the world, and one very focused and unwavering investment philosophy, and that is trusting in markets to do a good job of getting information that's known by every participant in the market into price on a daily basis. So our whole philosophy, and this goes back to the origins of the firm and to some of the academics who've been very closely associated with the firm, is to try and craft investment strategies on the free rider principle, which is that none of us have any more information in the market. We should be respectful to that phenomenon. And we're better as investors to act as though markets price securities fairly, and then use the information that's in prices to design portfolios with higher returns than the market, if that's what you want to do. If you want to take a market portfolio, there's absolutely nothing wrong with that at all. Okay. And the reason why Dimensional has that philosophy is because the people who started Dimensional, David Booth, our founder, Mac McQuown, who's the founding director of Dimensional, and some other very notable academics such as Myron Scholes, actually built the world's first index fund, okay, back in 1971, Wells Fargo's bank. And they were pioneering some of the concepts that were coming out of academia around how do you build a market portfolio. And the theory at the time was, well, what's the best equity portfolio to own in the absence of being able to have a strategy to systematically spot mispricing, zone everything in the market? Well, what does the market look like? And there was different types of models being developed at the time. Some were equal cap weighted, some were market cap weighted. The market cap weighted model has kind of won out in the end as a good starting point. And there's nothing wrong with a market portfolio. As investors, we are all the market, and we resemble that. And so the question then becomes, if you want to actively try and pursue higher returns than what the market has to offer, how should you do that? What risks should you take with other people's money, okay, not your money? As investment managers, we're fiduciaries or custodians for our end clients' money. And so based on the information at hand every day, how do you build portfolios with higher returns without guessing? And that's really what Dimensional is all about. That's what the body of work of modern finance is about. And the academics that are closely associated with Dimensional, both externally and internally, have spent their life trying to answer that question. Every second of every day, how do you build a portfolio with higher returns without guessing? Right. So that's the foundation of the talk today, and we can explore that in more detail. All right, let's move on to the next slide, please, Andrew. So Dimensional as a firm, what do we look like today? As I said, we're in 13 countries around the world. We have been running portfolios, investing in Asian securities for a long time, since the mid-80s. Our head office for Asia is in Singapore. We have 30 people on the ground here in Asia Square. We have had that office since 2012. We have about 120 odd people in Australia, spread across Sydney and Melbourne. We have a small office in Hong Kong, and also we have an office in Tokyo, which looks after the Japanese clients. If you think about World ex-Asia, the firm has been in North America and Europe for decades. And those offices are not only client service offices, but they're also trading offices. So on your screen, you can see a number of blue dots representing those cities. And inside the blue dots, you can see some light blue dots, which represent trading floors effectively. And so as well as being an office to serve our clients in Asia, the offices in Singapore, Hong Kong, Tokyo and Sydney are very important, okay, in being part of the engine to invest money for Dimensional all over the world. As I mentioned, the firm's about $500 billion US of assets, and that's spread across a variety of different clients. Some of those are sovereign wealth funds, some of them are large institutions. But the bulk of the assets come from independent fee-based wealth management firms like Endowus, because the investments philosophy lends itself very well to firms who are trying to deploy strategic asset allocation for their clients. As Greg said, the hard part of the wealth management game doesn't end with the planning. You need a good implementation engine to help you get there. And so that's where Dimensional comes into the relationship on both the equity and fixed income side for Endowus. And today we're looking at equities. So a bit about our origins. And if we go to the next slide, please, we'll talk about some of the academics associated with the firm. I think Endowus team do a fantastic job of peeling the onion, so to speak, or lifting the hood on the car to try and explain to people how markets work, what causes differences in security prices, and where that thought leadership comes from. Some of the academics most closely associated with or credited with helping us understand security market behavior and asset pricing theory are people that have had a long association with Dimensional. So most notably, on the very left-hand side of your screen, you can see a gentleman by the name of Eugene Farmer, who's a Nobel laureate. Next to him, Professor Ken French. They have been working with Dimensional collectively for 30 and 40 years. Professor Robert Merton, who is resident scientist at Dimensional, also a Nobel laureate. And then a few other gentlemen, Robert Novi-Marx, who's probably the foremost board expert on understanding the effect of firms' profitability and what that means for future expected returns. And then two other gentlemen here, also Nobel laureates, Myron Scholes and Merton Miller. Okay, so this is not going to be a history lesson, but it is important to understand, as Greg was saying, standing on the shoulders of giants in terms of people who have been independently recognised as helping us understand what causes differences in expected return and their close association with Dimensional, because what we are trying to do is put into practice the best learnings from academia every day without guessing, right? And that's really, really important. So to give you an idea around how this collection of ideas from academia have helped contributed to Dimensional and what we seek to do on a daily basis, we're going to play you a very, very short video which shows you a bit about our head office in Texas, in Austin, Texas, and what we do every day.
How is Dimensional different from other money management firms? I think the critical difference is the way we look at markets. We trust the markets. And over the long haul, that approach has served us well.
Dimensional is a firm that's dedicated to implementing the great ideas in finance That's what we're about. The idea was a small company fund, and we went out and tested the idea, and we were able to get a few clients. Obviously, we had no track record. Our first office was my apartment in Brooklyn Heights. It was a 2-bedroom apartment. My brother had been living with me, and he moved out and used that second bedroom as the trading room. It was run on the thinnest of margins, and we didn't exactly have success written all over it. When you start a business, one of the first things you worry about is, and people will say, oh man, everybody knows that. So I was particularly concerned about, was there research out there that we didn't know about, could be used against us? So my first phone call was to Gene Fama. I had worked for Gene as a research assistant and teaching assistant. And I called him up and said, look, here's what we want to do. And we invited him to be a founding shareholder of the firm and on the board of directors. We're blessed with working closely with Fama and French, who are largely the people that developed the data. One of the first things we discovered in running a mutual fund was that a mutual fund has to have its own separate board of directors. And so we thought, who better to monitor what we're doing than other leading academics? So we went over to the business school of Chicago, and first person we talked to was Merton Miller, who eventually would get the Nobel Prize for his work in cost of capital. And we asked Merton to be on the board, and he agreed. Next door was Myron Scholes, and we went into his office and invited him to be an independent director of the mutual fund as well, and he also agreed.
I think of it more as an investment philosophy that draws on the academic community.
We think that distinguishes us from the other managers. In this process, we have, the best minds, the people that have developed the research that leads to these conclusions about dimensions. So we're very comfortable with our process and very pleased with the results that have been achieved with it.
I mean, basically, and I don't know anybody else that would ever have this attitude, they feel that they should just let us do our research. And if something comes out of that they can use, then they will do it. But basically, they think we're working and it can be profitable to them, even though it's primarily academic work.
Dimensional, unlike any of the big banks or others that you would think of, or even other fund complexes, was founded on finance science. So the culture from the beginning matched my culture.
I consider myself to be an incredibly lucky guy. Have had the exposure to these great people with great ideas, be able to implement them.
There are many other companies that have used our research without us getting involved. Dimensional, they are different.
It's been fabulous working closely with such talented people. And I think what's great as well is that the biggest beneficiaries of all of this, hopefully, are the clients. At the end of it all, it's about the implementation of the great ideas. And these ideas are much bigger than the firm.
All right, thank you for that, folks. I made that video just to give you an understanding of the culture of the place and how it relates to the decisions we're making now in your portfolios every single day. David said, he hopes that from Dimensional, the biggest beneficiaries out of what we do are our clients, and putting financial science to work every day, not guessing, using information in prices, being disciplined. If we do that, we think that'll lead to successful outcomes, and has over the last 40 years. So let's scratch the surface on that now and think about, as investors, if you take a different view of markets and let markets work for you and use the information in prices, and you don't spend any of your money trying to outguess the market, then what should you focus on that can make a big impact to your financial well-being? So let's go and take a look at that, what's worked and what hasn't worked so well. Next slide, please. Okay. You may have seen some slides like this before if you've been around the Endowus community for some time. And that is, how well has the traditional approach fared? What do I mean by the traditional approach? If I'm an asset manager, I've got, historically 2 different choices, setting apart what Dimensional does from the rest of the community. I can actively try and find mispricings. That means try and figure out whether security is undervalued or overvalued. whether a sector is undervalued or overvalued, whether an asset class is overvalued or undervalued, and actively decide whether I want to be in that now based on what I think the future expected returns of that security are going to be based on what is happening in the future. In doing that, what you're basically saying is, I disagree with the market. Whatever the price is, I don't care. I'm going to make a forecast. I'm going to guess on what I think might happen. Whether that guess is well-informed or poorly informed, it's still a guess. The alternative of that has been, hey, what if you just bought a market portfolio? How well did you go if you look at just what the index did versus what the traditional active strategy was? There have been thousands of these studies done over the last couple of decades. The first groundbreaking study was done by a guy called Michael Jensen from the University of Rochester in the mid-60s, and he looked at the performance of all surviving US mutual 40 Act funds, or unit trusts at that time, going back about 20, 25 years. And of the 112 that survived, okay, what he found was none of them really outperformed more than you expect by random chance. Okay, so what does that mean? It means someone has to be holding the winners. So maybe you're lucky, maybe you're skillful, who knows, but someone's got to win. Okay, it's very, very simple. If there's only 2 investment managers in Singapore, and as an investor, you get to choose between those 2 managers, that's a simple model. In aggregate, the investment management community cannot do better than the market itself. The market does 10%, and there's one manager do more than 10, the other manager does less than 10. Okay, before fees. And then fees come into it. And after fees, the returns drop again. So what this slide seeks to address is just saying, okay, looking at the world's biggest market, which is the US, how well did investment managers do relative to their benchmark portfolios? Okay, to the benchmarks in their prospectuses, I should say. And the results aren't any different from what we've seen, in other studies. And basically it says this: if you look at the number of managers that were there at the beginning of the 20-year period, and then how many survived and beat their benchmark, it's about 23%. Okay, for fixed income, it's a little lower. All right, similar number of funds. What's the conclusion one could draw from this? One conclusion would be, hey, markets are easy to beat. I just need to identify the people that outperform the market and invest with those, looking back over the last 1, 3, 5, 10 years. And if I do that, I should be successful. Or I have some other method for picking the ones who are going to do better in the future. An alternative conclusion that could be drawn is, hey, it's really hard to beat the market. All these market participants are very well educated, very well paid, smart people. They're looking at every day. Why do so few of them outperform? Okay. Let's say we take the view of picking the ones who did well over the last period, wind that forward, and say, how do they do over the next period? We go to the next slide, please. I think we've got that. Well, the answer is inconclusive. Okay, so now what we're looking at here is sort of over the last 10-year period of this study. If you pick the manager one year, then you wind the clock forward and you see how they did over subsequent years and you average that out, only about 20% of them persisted into the next period. Okay, and this is exactly the temptation that many of us come across now. We say, here's one investment philosophy. How's it going over the last couple of years? Didn't work so well, I might change. All right, that's trying to win the loser's game, which is effectively saying, who did well last period? I know the performance doesn't necessarily repeat, but I'm going to do that anyway. Because as investors, we have many, many biases that influence the way we make decisions. Recency bias, extrapolation, familiarity bias, loss avoidance, all right? And so we need to be aware of these and we need to hold those in check when we're thinking about, that's very well for last period, what about going forward? Okay. Let's just say we managed to pick the right managers last period and going forward. How successful do we think that strategy might be on an ongoing basis? Effectively, you're left with the same set of choices. We're hoping that we can pick the people who can outperform, and we're assuming they can outperform because they can spot mispricings. Dimensional's endeavor is not to knock people who are trying to pursue higher expected returns. Our endeavor has always been, one, what causes differences in expected returns? Two, is that through skill or luck? If it's something systematic, can it be replicated? And what is the best way to do that at low cost? Okay. So at Dimensional, whilst we were involved in pioneering early index funds, we turned our back on that about 40 years ago because we realized if you try to track the market and tracking error is your goal, then one cannot outperform the market or get the market less a modest fee. That's absolutely fine. But if we believe there should be differences in expected returns, and then they can be identified systematically over long periods of time, you need to look different to the market, and you need to be disciplined in your pursuit of those. And so that's what really Dimensional has been about for years, and is still about every day. Dimensional started its origins from the University of Chicago with David Booth, as he spoke about in the short video. He was assistant teaching professor to Gene Farmer. He left, he worked on building the world's first index fund. And since then, everything he has done and the academic work of Dimensional has been about trying to identify, systematically what those drivers of higher expected return are. And so if we move forward, let's take a look at what we've found. Okay, so based on the premise that prices are fair, we don't know how to systematically misprice them, what can we look at to tell us about differences in expected return? Next slide, please. Okay, that means trusting the market, okay, and systematically identifying those long-term drivers. Next slide, please. Okay, one more slide. Here's what I'm going to summarize as being the most significant contributors to the differences in the return of securities in markets around the world. If you read the academic literature, serious academic literature, you will find articles that will citing over 300 different factors that cause differences in that return. Part of the very high bar of research that we set for ourselves at Dimensional is looking at all of those factors in isolation and then looking at them in terms of multiple forms of combination, looking at different ways of measuring all those individual factors and trying to distill it down to a model where you have the least number of factors driving return that give you a very good spread in return. It's doing it in a diversified way and where you can keep turnover low on the portfolio. Okay, and so effectively, I'll take you through each one of these four, but they contribute and explain the vast majority of expected returns. Okay, so we don't necessarily think that adding more does any more for the expected returns of your portfolio. It just adds more complexity. Okay, all right. So what are those for? The first of all is the broad market itself. Generally speaking, when people are talking about the broad market, they're normally talking about large cap indices. S&P 500, MSCI World Index, FTSE 100, whatever it might be. And so that drives most of the expected return within the market. If you are broadly exposed to equity markets and you do it in a diversified way, you have a good chance of capturing the equity market premium. From then on in, if you want to pursue higher expected returns, we think a sensible way to do that based on the foundation of valuation theory and backed up by decades worth of evidence, some of which I'll share with you today, you can do three things that will account for most of the difference in return over the long term. When I say long term, I'm talking multiple years to decades. First of all is pay attention to the company size. The lower the market capitalization, there is strong compelling evidence to suggest that you will have higher expected returns for that. Okay. The second is relative price. Often this term relative price is synonymous with value, but effectively what it's saying is that if you can scale companies using a relative measure, price to book, price to earnings, price to cash flow, price to anything really, there's information in that price that says securities are discounted to a price that is fair to buy them today based on their future expected returns. Okay, so the lower the relative price of the company, ceteris paribus, the higher the expected return. Again, there's strong compelling evidence for that. These are both really dimensions of price. They're discount rate effects. If I take two securities, two companies with the same amount of securities outstanding, the one with a lower relative price is the small company. If I take two securities with similar market capitalization and one is a lower price, that's also a discount rate effect. Okay, that's a valuation equation. All right. Profitability is the other part of the valuation equation, which is less about what you pay and more about what you expect to get based on future cash flows. And again, ceteris paribus, companies with similar market capitalization or similar relative price, the ones with higher profitability tend to have better returns through time. Now, these are not absolutes. They don't happen day by day, week by week, month by month, or even year by year. But if you look at the long-term data, if you form portfolios around these three dimensions, that accounts for the vast majority of difference in return in most equity markets around the world. Okay.
Joel, there's a couple questions circulating around the same topic, which you kind of touched on. And it's the active versus passive, and how dimensional is different from some of the commercial indices you alluded to. So like the S&P 500 or the MSCI World, or an ETF that tracks that particular commercial index. Could you just touch on that really quickly?
Yeah, I'd be happy to. So let's start with say an index fund provider. Traditionally speaking, most ETFs or funds that were tracker funds were tracking market cap weighted indexes. Let's call it, say, an MSCI World Index. The goal of that strategy is to hold, the top 1,800 securities held by market capitalization in perfect market cap weights. And in doing so, one should get the return of a market cap weighted index. That is the traditional way of thinking about index funds and ETFs. Dimensional doesn't do that. Okay, in a dimensional portfolio, we have hundreds or thousands of securities, depending on what the strategy is. So oftentimes many more than an actual index. And we're not trying to replicate the market cap weights. We overweight companies based on their size. So we tilt towards smaller companies. We also tilt towards companies that have lower relative price and also firms that have higher profitability. Okay. And we have a very systematic process for doing that. So dimensional is taking active positions, if you will, different from an index, with the goal of pursuing higher expected returns. The key difference between what dimensional does versus a lot of traditional active managers is that we're not doing that because we think securities are mispriced. We think that those groups of securities, small stocks, value stocks, and higher profitable stocks, will owe you higher returns. So it's not the individual securities that we think that we have preference for, it's large groups of securities. Okay. So comparing dimensional to, say, an MSCI World Index to a globally developed equity strategy, maybe you might have 7,000 or 8,000 securities in the portfolio. Why more securities? Because you're smaller in market cap weight, and every day you're tilting to portfolios that are not only smaller, but are more value or lower relative price and higher profitability. That's a very systematic approach that we take. How am I going so far, Greg? And explain.
Yeah. So do you have anyone, and I know the answer to this question, but for the benefit of everyone else, do you have anyone actually picking securities in the background? Like assessing, financial statements, balance sheets, future cash flow projections, all the analyst papers. Do you have someone ultimately saying, we need to buy more of this stock right now?
We have a lot of people in portfolio management and trading. Okay, so we have I'm going to say around about 300 people. It's more or less than that. I haven't seen the last numbers. Actively involved in portfolio management every day. And then on top of that is about another 100 people in research. Their job is to look at large sets of data to see how the security prices have changed every day. So they might be looking at the prices of 40,000 different securities around the world, and they're paring those securities down into different portfolios with different objectives every single day. I'll take the example, Greg, of say like a globally developed sort of core type strategy for equities. So they might pare that down to about 7,000, 8,000 securities. Okay, so for example, we will have a minimum floor below which we can't buy securities because it's too illiquid to invest in markets. Every single day as those prices are changing, we will have target weights for different parts of the market that we would like to own. So for example, a market cap weighted strategy, the biggest holdings in those securities are going to be your Facebook, Google's, Apple's, FANG stocks, etc., because they are the highest priced securities and therefore the biggest weights in the index. So every day we'll look at that and say, well, we want to own those securities because they're an important part of the market, but we don't want to own them in those market cap proportions. We'd like to own those at slightly less than their market cap proportions. So instead of potentially holding those securities at their market cap weight, we'll buy them at a slightly lower percentage. We'll take that weight out of those larger cap growth securities and choose to invest that money systematically into hundreds and thousands of lower market cap, lower relative price securities. Okay, so every single day we expect higher returns from smaller, more value securities and ones that are more profitable. So we're making active decisions systematically. It's very process driven based on new information that's coming into prices every day. Let's take an example. Let's say that one of the largest companies in the world right now, let's say some bad news comes out about that. Okay, in a well-functioning market, you'd probably expect people then to adjust their future expectations around the cash flow and future performance of that company, right? So what would happen then? You'd probably expect the price to drop. Okay, so it's becoming smaller market caps, probably. It's becoming lower relative price to other securities. And so that would be two signals to suggest, hey, maybe dimensionally you want to buy more of that security because it's worth less than it was yesterday. To us, that means there's higher expected returns. Okay, so that's example of one security out of 7,000 or 8,000. In reality, every single security is changing intra-second based on all the aggregate opinions of different investors coming into the market. So whilst Dimensional is taking active positions, we're doing it based on market sentiment. Okay, securities going down in price, we think it's information coming into markets. People are lowering their expected returns about that. As a long-term driver, Dimensional wants to own more of that. Okay, so far I've just talked about some of the long-term drivers. There are other things we look at over shorter periods of time, over months, and then intraday, which also inform our expectations. But there's 300 odd people looking at this stuff every single day systematically across countries, across regions, ranking securities based on their expected returns. But all of it is based on we're trusting the price of securities because everyone has looked at this. Lots of analysts have looked at it. People have different views and preferences. We're going to use that information in price to stay focused on high expected return securities.
Okay. So I think a good example of this is like, you're not, if a company makes phones, you're not looking at the specs of the latest phone they released, making guesses of how that will affect their sales and things like that. You're looking at the price of that security of that company and how that fluctuates over time, or what that is right now, whether or not it makes sense to buy it because it's lower in relative price or smaller size in terms of market cap.
Absolutely. Okay. Most traditional active managers are saying, hey, I see the price of, phone companies, call it Apple, right? They make phones and other stuff. And they look at all the information that's available in the public domain. And we'll have armies of analysts looking at things. And they'll say, that's interesting, but I think the price is slightly higher or lower based on my opinion about future cash flows and my opinion about the current discount rate being applied to that stock. And that current discount rate is the aggregate opinion of all investors.
Correct.
To hold the position that you think the world's got it wrong and you've got it right is a very confident decision. And maybe you get it right some of the time about some companies or some sectors or some geographies, but it's a very, very hard thing to do to think you're going to continually have more information to help you form those decisions. So at the basis of the philosophy is trust market prices, and rather than waste investors' money on resources trying to figure out whether the price is right or wrong, just step back and see how it fits from a size, value, profitability perspective. And that goes to sectors, it goes to regions. We spend zero time looking at GDP growth estimates. It's in the price. We spend zero time looking at oil prices or spot rates or whatever it might be, because it's all in the price. There's 7.5 billion people on the planet doing this for us systematically. Let everyone do that, then step back and see what decision you can make intelligently around long-term, short-term, and intraday drivers of return. And so far, we've just touched on the long-term drivers of equity being size, value, and profitability.
Okay, great, Joel. So let's let you get back to the presentation. There are a few questions. So from the audience, there are a few questions about, COVID impact, small cap outperformance, and around that. But I want to get back to that. I want to get through a little more content, and I'll raise the question when the time is right.
Got it. Let's hit COVID now. I think
Okay.
it's time, and then I'll get to the performance of different things shortly. Whenever there is big shocks, unforeseen events, right, that happen in the world, that tends to manifest itself in a lot of volatility in equity markets. Some industry participants would suggest that, hey, this is evidence that markets don't work well, or I told you so, or I knew this was coming and therefore there's been a correction, or that there's some kind of turmoil in markets. Dimensional's view, and COVID-19 being a perfect example of that, would be that whenever there are unforeseen events and something comes into the public domain, you expect that one of the first places for that uncertainty to be manifested would be in securities prices. Because people take their investments pretty seriously. They look at what's happening socially, politically, economically, and everyone's trying to figure out what the impact is going to be on cash flows of businesses, therefore their expected returns and what they should pay for them. So in a well-functioning market, what one would expect to see is a lot of volatility when you have big news events come into the public domain. And that's exactly what we saw as COVID-19 evolved through the quarter one and significantly through quarter two. A lot of market volatility in asset classes, a lot of cross-sectional dispersion of securities in different sectors and asset classes, because everyone's trying to figure out what's the right price. Are we overshooting? Are we undershooting? And the only thing you can really say empirically about periods with high volatility is that they are followed by subsequent periods of high volatility. It actually doesn't tell you anything about what the expected returns of markets or different parts of markets will be, whether that's the broad market, size, value, or profitability. So what did we see? We saw uncertainty. We saw a lot of trading in markets. We think it's a sign of a good functioning market, and we don't think there's anything. We're very hard to say if anything is mispriced or not mispriced. We would say it's a fair price based on everything that's known. So in terms of our philosophy on COVID-19, it's an unforeseen event which was reflected in security prices, and that's a normal state of affairs. Securities are always moving towards a state of equilibrium. Big shocks mean big volatility. So I hope that answers the question. I don't think it renders, a philosophy based on markets working inappropriate because of COVID-19.
Yeah, I think there's some more questions around how small cap companies are probably more affected by COVID, whether or not we expect the small cap premium, which is small caps long-term higher expected returns versus large caps, to persist. Given technology being, having more access to data, being more online, and things like that. So, you may be touching on this later in the presentation. We can get it back to it, or we can cover that now.
I think we go there now. We're looking
Okay.
at dimensions and the differences in return and what causes those, which is effectively discount rate effects. So let's go back to the presentation, and I will do my very best. I'm conscious of time here. We're coming up 10 minutes to the hour, Greg. So I have time to stay, but I need your guidance on where to spend the rest of the time, because we've got 10 slides to go.
Just keep on going. I think
All
I
right.
can stay with you, but people may have to run off.
Wonderful. It's a superb question. how do different economic regimes affect different companies in different regions or different market capitalizations or value or whatever it might be? And there's lots of theories and opinions. And one of the hardest things to do is to look through the theories and opinions and look at the data. How have small cap companies gone through periods of market expansion or contraction? How have valued companies gone through the same thing? All right, and the answers are out there if you want to look. Let's take a look at the prices historically, then we'll talk about what we think is happening in markets at the moment. So we'll go to the next slide, please. Okay. Here's the returns of size, company size, relative price and profitability, working down the page. So Andrew, if you've got your cursor there, I might just get you to run those over those three variables. So we'll look at company size, which is the top row, right? Company size. And then I can't see your cursor on page. There we go. There's the magic pen. Okay, so what this is basically looking at, this is a sort of roughly the bottom 10 to 12% of the market. If you read the footnotes, it'll be one of those. And this is not dimensional funds. It's just a representation of the size premium. Okay, so how is that fared? In the first column, you're looking at the US market. We can measure that back to 1928, a fairly long period of time, sort of 90 odd years. There's been a premium, an annualized premium of about 2%. Okay. You then look at the rest of the developed world. You've had a premium of just under 500 basis points for size. Okay. And then it goes back to 1970, so a significantly shorter period of time. And then you look at emerging markets, okay, which is a little under 2%. If you look at the statistical significance of these things in different markets and then you aggregate them up, they're statistically significant. So what does that mean? It means there's a decent degree of confidence that they're not there by chance. And we would expect them to be there. The challenge with it is that they're very, very noisy. They don't consistently show up year by year, month by month, quarter by quarter, or even multiple year periods, okay? And so there's always a tendency to think, okay, well, what has the premium been? Is it going to hold up in periods like this, like we're in now? I think over the last couple of years, Andrew, can you go to the next slide, please, for me? So these are the long-term numbers, sorry, just before I move on. So the premium are time varying. They're very noisy, but they're statistically significant, okay? And so 2%, 4%, 2% for size, value a little larger, and profitability, similar order of magnitude. The question is, in what circumstance would you expect it to be there? The answer is we have looked intensely, all right, for information, reliable information, even on a before fees basis that tells you, can you change your exposure based on the time varying sort of volatility of this premium to get abnormal returns, i.e. get out of size when it's not going to be there or go longer into size when you think it would be there. We find nothing empirically that suggests there is a way of doing that, okay? Because these things are risk premium. If there's one ratio or set of ratios we could look at to time them, which would be pleasing, there's a good argument to say the premium would just go away because everyone would know and you could look at that premium and then whooshka, it's gone, okay? So it's very, very hard to do. Maybe let's go and look at the last 10 years and then I'll talk specifically about the most recent period we've been in, sort of this year. So next slide, please. Here's the last 10 years. Not as attractive. And I'm sure many investors would say, wow, we've just gone 10-year period where size premium wasn't there in the US, but it was there in the rest of the world. Value premium wasn't there at all, right? And then the profitability was significant. Now, these are annualized premium. The premium were positive some years and negative in others, but this is the experience we've been.
Yeah,
so,
I think, Joel, just to clarify for everyone's benefit, the premium is relative to what exactly?
It's the delta, the difference between large and small cap securities. Okay. Right. So the first slide showed you how there was a 200 basis point premium for 90 years. I would say it's a pretty good bet. And then we say, okay, over the last 10 years, what happened? Well, it was negative 1%. Okay. Value premium is the premium for value stocks over growth stocks, or low price versus high price. And then profitability is the delta between high profitability stocks and low profitability stocks. Okay. And so it's intuitively pleasing for one to look at what's going on in the market now and say, boy, wouldn't want to be a small company, got a high cost of capital, probably can't pay my staff, cash flow is probably not so good, you look like you got tough times ahead. I don't think that's lost on anyone. I think the whole world knows that. We see what's going on in Main Street. We see what's going on with small retailers. We see what's going on at the local hawker centre. You see businesses with cash flows. So that's evident, and it's already reflected in stock prices. Okay, and so what you're seeing on a daily basis is investors looking at the small cap companies with that information priced in, and that discount rate being applied to small companies intrasecond, as it is to large companies, large cap growth, high profitability companies. And so the market is a great mechanism for synthesizing all of this information and constantly adjusting to try and figure out, is there new information that's to suggest cash flow should be higher or discount rate should be lower, such that the price is fair. And the thing that we forget as market participants is that all security prices should be fair in a well-functioning market. Okay. Now, based on the premise we are working in a well-functioning market, as we don't see any evidence of it not being at the moment. That's a whole nother question, how you measure that. But as investors, mechanisms should be set so that we're indifferent to what security price we buy. So the intuition that small cap companies should do maybe not as well in environments that are tough for various reasons, or the same for value, it's already priced in. The question is, will they perform better than expectation? And that's a multi-period expectation that is changing intrasecond as more information comes into prices. Okay, so it's like line betting. It's not, has the market got it wrong? It's, do you have more information in the market to suggest that the price is not already discounted enough? Okay, now if one looks at the performance of small companies and value companies through time, through different market ups and downs, and then looks at the subsequent performance of small value market and high profitability companies, they're relatively persistent in that after periods of big lows or big highs, they still tend to have higher returns than large cap growth companies. I'll be happy to follow up with more information on that. At the moment, there is a lot of people driving the price up of large cap growth securities, particularly US technology stocks, which is not a new phenomenon. We saw this phenomenon again in the late 90s with huge differences in valuations on US technology companies. I'm not saying it's right or wrong, it's just people voting and thinking the world's changed. Never going to be the same again. Traditional fundamentals are out the window. Discount rates don't matter anymore. We stop believing in discount rates as being a representation of risk and return, then that's pretty fundamental to modern finance. So have small cap companies done worse than large cap companies this year? Absolutely they have. Yeah, have value companies done worse than growth companies? Yes, they have. No one's arguing that. It's been a painful run for small and value investors. But this is the price one pays. This is for wearing that risk. That risk's always been there. It's just being manifested. Okay. And it tells us absolutely nothing about the return tomorrow. So in choosing to invest in small cap and value securities and high profitability securities, we should expect that they're there every day, although that it's not, because there's a lot of noise around these returns. If you look at these historical averages, very, very often does the annual return fall anywhere near the historical average. There's big highs and big lows. So just before we move on to any more slides, I'll pause there to see if we did an adequate job of answering those questions, or if you think there's some things we'd like to probe on in a little more detail to get people comfortable with these concepts.
Yeah, I think I just want to, emphasize a point that you made, and that is that the price today reflects the information that we know, and the price is constantly trying to update itself through the market participants, right? And it's a pretty big number in terms of the value going through these securities every day.
Huge.
Yeah.
Let's just flick back a couple of slides, please, Andrew, to give you an idea of the quantum. Right, so let's, sorry, Andrew, there we go. Okay, so this is maybe 12 months old, but saying like world equity trading dollar volume 2019, this is a daily average, $450 billion of trading. That's a lot of information getting into prices. I mean, who's missed the fact that COVID-19 is going on? Markets are aggressive and they're cutthroat. People are putting new information in all the time. Rational, irrational, based on what they see on balance sheets, based on what they see on cash flow statements, based on what they're seeing on fundamental ratios and forward-looking expectations. Okay, so the question isn't, has value or small done worse? Do you expect it to do it? Is, will it do better than what it's being priced at today? Right? Theory would suggest you every day you should be at higher returns for size and for value securities because they're discount. It's a discount rate effect. You should owe higher returns if you pay less for something, ceteris paribus. Okay. Otherwise, no one's ever going to invest in those securities. They have to have discounted prices because they're riskier. Profitability is the flip side of that, right? If one expects a company to be more profitable, it should pay higher dividends, it should have more higher expected returns, and that has been persistent at time. So nothing's changed in the theory. We've just gone through a period where the realized returns haven't been as great. But at Dimensional, we have every confidence that that will persist through time. These returns will be realized. This is just the discipline part of being a long-term investor. Risk and return are related, but they're not simultaneous. At the moment, we're wearing the risk part. And history has shown that over time, you've been rewarded for taking those risks. Okay. So maybe just go to the next slide, please, Andrew. So here's what I mean. Okay. We all have very short memories and no one likes going through a period where relative performance isn't quite as nice. Okay. If you look at the last 12 odd year period that large cap growth stocks, particularly in the US, have done better than small value, they have gone through a period where their return has been anomalously high. Okay, way higher than their long-term average. Size and value hasn't been that different from their long-term average. Okay, that doesn't happen that often. And this is part of the problem with recency bias and extrapolation. People think that what's going on now, it's new, different, it's different this time, it's a new paradigm that's going to carry forward. And that's where you need to lean back on valuation theory and what history has taught us. So if we look at the graph here, Andrew, maybe you might be kind enough to get your magic pen, okay, and then just draw a circle around value beating growth. Prior to 2019, right, the value premium, that sort of 4-5% premium, had only been there 80% of the time over rolling 10-year periods, 82% of the time. Well, guess what, folks? We're going through one of those periods now. Okay, that risk is always there. We just hadn't felt it very recently. Okay, but again, this is the risk we're being paid to take for being disciplined value investors, right? And in the strategies that Dimensional are running, I don't think any of them are pure value that you guys invest in, Greg. You invest in multi-dimensional strategies. One of the other things that we've learned is that if, when Dimensional started, it was a small cap company. We offered people the ability to invest diversified, low-cost weighted small caps as well as large caps because they're not perfectly correlated and it's good for the portfolio to be diversified across both. That was our story. In the early 90s, we started bringing out value strategies based on a lot of the academic research that had been done, which suggests if you combine small and value, you'll get higher returns. Okay, that has been the case. We've gone through long periods of time where that hasn't happened. One of those is most recently. The other dimension that we combine into this is profitability. If you look at the profitability numbers in the bottom right-hand corner, Andrew, if you'd be kind enough to get your pen out there. Again, sort of 90% of the time you've had that. but 10 to 20% of the time, if you lose size and value, you haven't. Okay. And so we just need to be a bit disciplined around that. When you combine size, value, and profitability, right, you increase the probability of outperformance significantly. And if you do that in a diversified way, but again, they're not guarantees that you're going to do better in every period. You're just increasing your odds of getting that outcome by working with the market and without trying to outguess what's happening. Greg, I'll pause there to see if we're making some headway on developing an understanding of why one might want to do this with their equity investing.
Yeah, I think let's keep on going. I'm preparing some additional questions for you, but I'm conscious of time as well.
Right. Okay. So we're almost there. So again, I've said so far, the research I've shown hasn't been really about what dimensional does. It's just the theory. So what do we need to do? If we want to outperform the market, our submission would be you can do that by using market prices every day, by acting as though size, value, profitability will be there, and there's no guesswork. It's supported by valuation theory, supported by long-term evidence. Why we do it is because going forward is the assumption will be there based on valuation theory, not because of the evidence. The evidence is.
So Joel, just to confirm for everyone, is there any way, an evidence-based way of timing these factors?
I wish we could find that.
I mean, there's some questions.
Self-interest to want to know how to do that.
Yeah, I think there's some additional questions around, the min vol or the max vol or the momentum or any of these factors that can be cut and chopped up in different ways. Why doesn't dimensional? And you mentioned this at the beginning, but why don't you want to touch that stuff?
I'll give you two reasons. So we have 6 guiding principles of dimensional. Number 1 is acting in our client's best interest. Number 2 is to base things on a scientific methodology. Okay. So we don't want to add something into the portfolio because it's easy to sell or because you can run a paper portfolio around it, but can it make a meaningful difference to the portfolio? So dimension, we don't see our job as defending the arguments on which the firm has been built. We're continually looking for new sources of information to break the models that we have to get better returns for our investors. And so we want to find ways of continuously improving the portfolios. Let's maybe go to the next slide, please, Andrew. We'll jump ahead to here. So part of it's research, and one's determining which factors work or not. Min-vol strategy, adding a min-vol factor to the structure that we have in, say, a core type strategy, we don't think will improve the returns because we're already capturing the vast majority of returns by looking at size, value, and profitability. Okay, even though if you look at it in isolation, perhaps there's an argument to suggest that it would. Momentum is something that we incorporate through portfolio design, portfolio management, and trading, because it is an important driver of returns over the short term. Okay, and I'll move on to that next. So that is something we do look at. There are a few other things I'll touch on as well. Okay, it's not just size, value, and profitability, but they're the long-term drivers. And when it comes to trading, execution on how you trade, the prices you pay, how much you push around prices in markets, the venues in which you trade, the way you size orders, and when you decide to work away from trades has a big impact on returns as well. Okay, it's just not just the long-term drivers. So let's go to the next slide, please, Andrew. And we'll go to the next one to sort of cut through, please, Andrew. Next slide and the next one. Okay, so the long-term drivers, well supported in the academic literature, and Dimensional implements those in portfolios. Other things that are popular in the academic literature, low beta strategies, min-vol, different ways of measuring quality. You'll see other pricing theories like risk parity strategies and other. For us, they don't meet the theoretical foundation that is required for there to be higher expected returns. If you look at min-vol strategies, they're pretty much explained by value. What was value doing through different periods of time, and did that cause higher or lower returns? There's also not an argument that sits comfortably with us to suggest that lower volatility strategies should owe you higher returns individually. Okay, so there's a bunch of reasons why we don't include min-vol. Momentum from dimensional perspective, is empirically persistent. It exists in most markets around the world over long periods of time, other than Japan. We don't think it's a long-term driver of returns, but it is a persistent empirical phenomenon. So rather than designing strategies around it, we take it into consideration when we trade. So for example, we're trying to identify large groups of securities with higher returns. We'll look at size metrics, valuation, value metrics, profitability metrics, and start to design portfolios around that on a daily basis. We also look at the price momentum of securities in all of the markets that we trade on a daily basis to slow down execution with securities with strong negative momentum, and to delay its buying, and to delay sells with insecurities that have high upward momentum. Okay, we've been doing that for a long time. Nothing new in momentum. The original papers came out in the early 90s, and we've been looking at it since then and having the portfolio for a long time. So for us, it's a way of improving execution costs, and it is important in driving returns over multiple months. Okay, so momentum, it's important. You should definitely pay attention to it in execution. Another one we look at there is securities lending prices. Okay, there's information in securities lending prices that has information around securities that are expensive to borrow, tend to have really poor short-term performance. Okay, so dimensionally, we do securities lending. We put all that money back into the portfolios. And when we're figuring out what to buy and sell every day, we also look at that short-term information in securities lending pricing. Okay, growth on assets or company investment or reinvestment is like the flip side of profitability. That also has some information around expected return securities, and we use that in a shorter-term manner to help improve the performance of securities. Then when you get to trading, that's all about intraday movement and understanding the microstructure of the 45 different markets we trade on every day. The key to using information in prices when it comes to trading is to ensure that when you execute, you're executing at best possible prices effectively by looking at large groups of securities. If there's a couple of hundred small value, high profitable securities we'd like to buy today, and we'll buy the ones that we can execute at best possible prices by providing liquidity to the market and not chasing sales and therefore crossing spreads and giving away returns. And so it's the combination of trusting markets, having a really good understanding of having a few drivers that explain the vast majority of long-term returns in markets around the world, combining that with shorter-term information that's in prices around momentum, securities lending revenue, growth on assets, and then executing, buying exactly the securities you want in the proportions that you want without regard to an index, such that you're giving your portfolios the best chance for higher expected returns every day. So it's a very disciplined, process-driven system, which is reliant on human judgment, but nothing is reliant on trying to outguess whether the price is right or wrong, or whether large caps or technology stocks are going to do better, or some kind of guess. And that's the key thing that I'd like investors to understand, that the role dimensional plays in Endowus portfolios, as you said, to do what we say we're going to do, to be disciplined around the long-term drivers of return, to do it in a very transparent process in a very diversified way. And we have every confidence that if we continue to follow that process, then that should result in good investment outcomes for investors in the funds. Sorry, Greg, I'll pause there. I was trying to cover a lot in the last couple of questions.
No, I think that's very, very helpful. I guess, one thing that we get asked a lot, relating back to a question we asked earlier on the difference between active and commercial passive. So like a ETF that tracks a commercial index, let's say the MSCI World. Dimensional, to get similar exposure, might buy 7,000 securities, and MSCI World might buy 1,800 or 1,600 securities or something like that. I mean, is there such a thing as too much diversification? Like, is it worth all the trouble?
Yeah, that's a great question. So thank you for bringing it up. When it comes to equity investing, and I'll say this is probably different for fixed income, then the answer is diversification is your buddy. Okay. And that comes from Merton Miller, who was a founding director of Dimensional, Nobel Prize winner, for the work he did on capital structure of organizations and cost of capital being the expected return of investors, fundamental to discount rate. Diversification is your buddy. We want to own as many securities as we can because it gives us flexibility in portfolio design. Again, it's and also in execution. So it keeps trading costs low. You've got more securities in the portfolio, you've got more options. You can walk away from trades and you don't particularly care about the individual names. It's just the rough weights. Okay. So some of the argument behind too much diversification is not good stems from the world of traditional active management, where you're an information trader. And I think Apple is better than Facebook because Apple is mispriced. So I got to get into Apple today. I'm going to waste all that good thinking on a bunch of other securities. It's just fodder in my portfolio. I want to save it for my high conviction ideas. So if one has the prior that they have more information than the market and that all of their resources should be put into only those high conviction ideas, then it probably makes sense under that guiding philosophy that you don't want to be too diversified because you'll diversify away your ability to generate alpha. We would approach that very differently and saying the market portfolio is a great way to start. Then if you want to try and seek higher returns, I'm not suggesting everybody should. Okay, I'm not suggesting that. I'm saying if you want to do that, having a systematic framework for doing that is a great way to do it. And if you're trying to do it systematically, then you want to reduce as much idiosyncratic risk in your portfolio as possible. That means as many securities as you can, because you don't know which ones are going to do the lifting. Okay. Many people look at the same research that's been done by Gene Farmer and Ken French and others, say, that's a great model. I'm just going to pick just the good value stocks or just the good small stocks because the other ones couldn't possibly work. Again, that's putting one's individual preference on whether securities are right or wrong into it. And what we've found is when you're trying to harvest systematic premium, like the size effect, the value or profitability, the more securities you have, the better, because you don't know which ones are going to do the lifting. Okay. Not all value stocks have performed badly this year. Not all large cap growth stocks have performed well. There's a lot of cross-sectional dispersion. And because the future is based on unforeseen events, you don't know which ones they're going to be. It's always a handful that do the lifting. That's why you want to be as diversified as you can. So if Dimensional is trying to implement a broad-based market portfolio like a core strategy, then you want to start with the market. In fact, when we say the market, we don't mean an index, we mean all the securities we can. If there's 44 different countries you want to trade and there's 40,000 securities that are listed, let's start paring those down to have a floor on market cap. And let's take out a whole bunch of stuff that might be suspended or delisted or you can't trust the price for whatever reason. That still leaves you with thousands and thousands of securities as a starting point. And then from that, Andrew, if you just go to the next slide, so go back, Andrew, sorry. So market cap weights is a good place to start, okay? Because what that's doing, it's aggregating the whole world's opinions about the future expected return securities and saying this is the starting point. People are owning FANG stocks the most at the moment because they think they're going to give them higher returns. Well, we're not going to argue with that. That's the case. From there, what can we do? We can make it more diversified by going smaller market cap, taking some of the weight at a large cap growth, put it into lower relative price and smaller cap value securities, being mindful of profitability so that every step of the way, we still want to own large cap growth stocks. We want to overweight the more profitable ones. Take some of the weight out of that part of the market, buy more mid cap, more small cap, more value. We want to own everything, but just in a way that is cognizant of the long, medium, and short-term drivers of return. And so if you think about what you're doing to give you a visual, if you go to the next page, Andrew, what you're doing is looking at that world market cap chart and saying, I'm not going to make any calls around whether the US is going to do better or Japan or Singapore, whatever it might be. I'm just going to buy that. And then within those countries, I'm going to overweight on size, value, and profitability. And then be mindful of momentum and securities lending revenue and growth on assets and trade really intelligently. It's that systematic process. And every single day, prices coming in, I'm going to set my portfolios, prices are going to change. I'm going to get some trades, I won't get all of them, I'm going to do it again the next day, the next day, the next day, the next day. Okay. And so what you end up doing is every single day, you're overweighting, Andrew, if you could get the magic marker, please. You're overweighting, unlike a large cap, like an index, which overweights the lowest expected return part of the market. It's just what people have bought. You're underweighting those and you're overweighting the more small value, that higher profitability securities.
There are some questions about, how do you access dimensional and things like that, and is dimensional available for SRS? And the answer is yes, dimensional is available for SRS. But Joel, maybe you can quickly touch on sort of dimensionals, the way dimensional works with financial advisors.
Absolutely. Yeah, sure. So we don't pay commissions. Okay. And unfortunately, in Singapore, most of the way traditionally that end investors have accessed fund management companies with dimensional is that they would pay a commission for people to sell their products. So that has precluded us from working with large parts of the investment community. Hopefully what you would have seen from dimensional is that our raison d'etre, if you will, is to understand what drives differences in security prices, to try and build strategies in a low cost, transparent way for people to use, and then to work with financial professionals, wealth management firms like Endowus, who are working for their client. It means the client is paying them for their advice, and that if they like our funds and they think it's, you think we're in the best interest to be used by clients because of what we do, then that's a good marriage. Okay. And around the world, that has proved to be a good thing. And we're very happy to be working with Endowus and a small number of other firms here in Singapore. The rule-based dimensional has always been around. If you like the funds, you want to use them, great. But we don't have a commission model here in Singapore. So, Greg, if that helps lend some context to the way people would access dimensional, I hope that's helpful. If there's more we need to elaborate on, then let me know.
Yeah, I think it's important to note that, there is no transfer of money between Endowus and dimensional, and that we aren't paid for selling dimensional funds. And in the most of distribution, fund distribution in Singapore, but in Asia, actually most of the world, the distributors make the bulk of their money from the fund managers.
Yeah.
And we think that leads to potential misalignment of interest because, I would want to sell a fund that paid me as a distributor more than dimensional, which pays me nothing. So, one of the things that Endowus does is tries to make it fair. And in making it fair, we cannot get paid by anyone except for our end client. I think there's a misconception usually around even low-cost fund platforms. And actually, they're very upfront about it. They say, you don't have to pay us anything because we make all our money from the fund managers. But that actually, in our view, that actually leads to misaligned incentives, possibly. I'm not saying they are doing anything, against you on purpose, but it does lead to misaligned incentives.
Yeah. I think you want to put, as an investor, you want to do as much as you can to reduce costs and put the odds in your favor of success. And I think alignment of interest is huge. And it also informs, Greg, very much investment philosophy. I think traditionally the reason why you don't often hear of firms like Dimensional or others is because there's not a new story every week. There's not a new idea. Hey, last week's investment story was great, but it doesn't work anymore. Now I've got a new one. It's because when you're in the business of selling funds, you're selling funds. There's often an interest to want to put a new story in front of someone. When you have a story which is, hey guys, markets work, accept prices for what they are. You don't need to try and outtest the market to win long term. You should do some simple things. Get your asset allocation right, be disciplined, understand how markets work, right, and that risks are priced in. Through discount rates, you expect lower, higher returns from small in value and more profitable companies over the long term. And that's not a sexy story for a lot of people. Okay. But if we can, as investors, we can sit back, think about what are my goals, what do I want to achieve, keep costs low, be diversified, make sensible long-term decisions. I think that's served people very well. That's why Dimensional manages so much money on behalf of fee-based wealth management firms. And we think it's a solid investment philosophy in the context of having a good, disciplined wealth management professional to guide you through asset allocation going forward as well. So if that's a helpful context for people, I think it's the one we should be mindful of.
Yeah, thanks, Joel. So something very important in terms of what Endowus provides is best-in-class funds, access to those best-in-class funds. I mean, Dimensional is one of our key fund management partners. As anyone who's familiar with Endowus would know, they make up a very large part of our advised portfolios for our cash and SRS portfolios. Hopefully other types of money in the future as well.
That is a hope. Yeah.
There were some questions around, CPF, Dimensional, things like that as well.
Yeah, I think the Dimensional is working very hard, right, to become part of the CPF system here. And so we're working through some things, and we hope that the day comes and we can be a partner for that as well. But we'll watch this space.
Yes, everyone. So stay in tune with the space. If anything does happen, we'll obviously let everyone know. Remaining low cost, that goes straight to your bottom line as an investor. Being globally diversified, we don't have a hot story as well, because we're really trying to help you achieve long-term wealth. Being efficient in your currency exposure, so being Singapore dollar denominated for your equity, Singapore dollar hedged for your fixed income exposure. I mean, you can find that in the Endowus portfolios. Very important, 100% trailer fee rebates. I mean, Dimensional is a firm that does not pay trailer fees, but there are times where the only fund that is possible, and many in our CPF portfolios are funds that do pay trailer fees. In the case that we do get these trailer fee kickbacks, we rebate 100% back to you, the end client, so that we are not incentivized incorrectly in putting you into higher cost funds that pay us higher trailer fees. Endowus provides expert advice that is personalized and strategic to your asset allocation. There are no lockups. There are no sales charges, no redemption fees. There's daily liquidity, so you can sell within a day. And again, we are tax and currency efficient in Singapore dollar hedged. We're not buying US listed ETFs, which may not be efficient from a dividend withholding tax perspective, as well as potentially an estate tax perspective. And the money and positions are securely held in your own name at UOB Kay Hian, your custodian, our custodian broker. And all of this culminates in allowing Endowus to be the first and only digital advisor for CPF, SRS, and cash. Again, next week, we'll be talking about Endowus Fund Smart. We still have 80 people on the line right now. So thank you everyone for joining us for such a long time, and sorry for running over. Joel, thank you very much for being here today and explaining the Dimensional philosophy. And we're very proud to be able to, use Dimensional as a building block for our client wealth needs.
Greg, thank you. We always appreciate the opportunity. We're cognizant that our investment philosophy and structure that we use for investors is different. And it's not a story they hear every day. So we're always happy to come on and talk and explain about what we're doing and why that should make sense to people long term. We're passionate about it. We had some other material we were going to share today. A lot of that is available on our public website. So dimensional.com, if you go to the website, you can go to the public Singapore website. There's some great insight on there from dimensional thinkers, others in the academic community, and lots of client-ready pieces that talk about the time-varying nature of size and value premium, and what's all the buzz with US technology stocks, etc. So I'd welcome you to do that. Most of these resources, the guys in Endowus are already onto them really, really quickly, and I think they do an even better job of taking these concepts and putting them into words and phrases that are more palatable for a lot of end investors. But that resource is there for you, and again, we're happy to come back anytime and share some perspective on what's happening in markets.
Yeah, so I mean, I think a lot of people listening right now are probably already very interested in dimensional strategies, and I highly encourage people to check out Dimensional's resources. They're very data driven. They're very integrity. They have an extremely high level of integrity, and now they are available on Dimensional Singapore website. So please do check that out for yourself. Talk about value versus growth. Talk about large cap companies, outperforming recently, and what to expect in the future. So thank you everyone for your time. I think we'll wrap up there.
Pleasure. Thank you and good evening. Stay well, everybody.